I think the North Korea thing, although it's very important from a humanitarian perspective, for markets less so. I mean, that could add to sentiment on a sort of daily or weekly basis, but I don't really seeing it changing any of the trends inside Asian or global markets.
Right, and perhaps some of the bigger drivers are the ones we've been talking about a lot, which is the potential of a deal between China and the U.S. and a dovish Fed as well. Looking at some of the market price action this year, we've already got Chinese equities up anything from 15 to 20%. Is all the good news baked in?
Yeah. Sorry, what's that?
Is all the news priced into the markets at this point?
Oh, okay. So I think right now we're still very much in the middle of this pain trade. I mean, when you look at the surveys of either institutions or retail, they're either underweight or holding a lot of cash, and you're seeing the price action, whether it's S&P 500 or China, where we're pretty much ticking up every single day. I'm not seeing many sort of stats around that cash holding going down materially yet. But we are at pretty big technical levels on the S&P in the US, around about 2,800. So this really should be the point where the bears come out and start reloading short. So I think this will be a fascinating point for equity markets. But I think generally for us at Morphic, we were more surprised really about how far the market fell than how far it's rallying at the moment. So we still sit in the bullish camp.
So you think there could be another leg higher then for U.S. equities despite the positive start to the year. I want to come back and ask you about your view on fixed income. My colleague Hadley spoke to Larry Fink over the weekend and asked him about one of the repercussions of the U.S. trade war. One thing he said is that one potential inadvertent consequence of signing a deal is that China's surplus will reduce, perhaps even tip into deficit, which means they'll effectively be buying less U.S. treasuries. Do you think that that could be a problem for the U.S. over the medium term?
I mean, I think sort of mathematically is exactly correct. The huge holding of U.S. treasuries by the Chinese is essentially the mirror image of the large trade surplus that they've had with the U.S. Now, as the U.S. sort of manipulates its trade position with China, you're also getting trade surpluses opening up in different parts of the world. So, say, for example, if you're a manufacturer in China and you move your plant to Vietnam to get around the potential tariffs, essentially you'll now increase the surplus of, say, the Vietnamese, and they will then be the ones that step in and start buying treasuries. So while the Chinese position in treasuries may reduce, what I think you'll see is other global countries will take up that slack as their surplus increases.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.